This is Bloomberg Wall Street Week.
The global push into infrastructure, breaking the IPO logjam in tech.
The financial stories that shape our world.
Cutting inflation without losing jobs. Do we need rate cuts? And if so, how many? Investing in a time of geopolitical turmoil.
Through the eyes of the most influential voices.
Ken Rogoff, economist of Harvard. Former FDIC head Sheila Bair. GE CEO Larry Culp. San Francisco Fed President Mary Daly.
Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
From Beverly Hills for the Milken Institute Global Conference, this is a special edition of Bloomberg Wall Street Week. I'm David Westin. This week, Karen Karniol-Tambour of Bridgewater on the geopolitics of industrial policy.
Everything you're seeing in industrial policy, officially it's doing something else.
Former Treasury Secretary Stephen Mnuchin on his plans to buy TikTok.
I do believe the algorithms could be rebuilt. So my plan, if we were to purchase it, would be to rebuild the technology under U.S. leadership.
And Barry Sternlicht of Starwood Capital on why he's so unhappy with his alma mater, Brown University.
They should be shown the door. And I don't want to pay for them, so I don't want to support a university that houses that language.
We began the week at Milken with Marc Rowan, Apollo CEO, on the surge in private credit and why he believes it's a better way to go.
If you look over time, we had 8,000 plus public companies in the U.S. We now have just over 4,000 public companies. We should logically expect, therefore, to be more in the private markets. And I don't think people actually appreciate the scale. And this is not just U.S., but it's U.S. and Europe. 80% of companies over 100 million in revenue are private. 80% of employment, private. Why would we not expect a growth in the private marketplace?
So why is it a better mousetrap? I mean, fundamentally, I think about banks as being intermediaries, sort of between people putting capital up and people needing capital. Why is private a better intermediary than the big banks?
So let's work in reverse. What are the needs for financing today? We're financing infrastructure, long term. We're financing energy transition, really long term. We're financing the new economy, data centers, power, really long term. Long term financing needs. What do banks do well? Banks borrow short and lend long. They are not ideally situated to be investors in long term assets. And so regulators, when they look at the funding for the economy, they only have two choices: the banking system or the investment marketplace. Increasingly, since 2008, regulators have chosen the investment marketplace to provide financing. Now you come to the investment marketplace and you have two more choices. You have daily liquid funds, or you have long-term investors who are trying to match long-term liabilities and long-term assets. I think the choice is obvious. Do we really want to create more instability in our public markets by matching long-term financing needs with short-term daily liquid funds? I don't think so. We are watching the logical outgrowth of changes that started in 2008, that accelerated through a zero rate environment, that were exacerbated by COVID, that were then refreshed by SVB and FRB. And this is not just happening in the US, it's happening everywhere in the world. Regulators are looking at the choice of how they fund their economy, and they're choosing investors over banks. That doesn't mean banks shrink. It just means on the margin, the growth is going to the investment marketplace.
Are there some things that public markets do better than private markets? You've described some of the things private does better than public. Are there some things that public really does better?
Look, we have in the US in particular, a focus on daily liquidity. If you want something that is daily liquid, if you want pricing every single day, you can only accomplish that in public markets. Private markets are not going to give you daily pricing. They can give you an indication of pricing, nor are they going to give you immediate liquidity. So if you want something that's immediately liquid, you're talking about the public marketplace. If you want access to vast amount of capital today, because that's where the capital is, you're talking about the public marketplace. But if you're talking about matching long-term capital needs, you're really talking about the private marketplace.
When you talk about daily pricing, some people hear transparency. That is to say, you have transparency in the public markets and not in the private markets. Is that right?
I don't really think so. So let's start in the fixed income market. You own a public bond. Can you sell that public bond? Maybe. On average, it takes about 5 days to sell an investment grade public bond today. When you see a price or a quote, That's for a very small subset of the bond market. In the private market, can you sell your bond? Yes. On average, probably takes you about 5 days to sell your bond. What we're watching as private markets get bigger, we're actually watching increased liquidity in private markets. It's not to say it's the same as public markets, it's not. But this notion of transparency is actually itself an interesting thing. Are private markets not transparent? This is the argument that the regulators make. They talk about private credit as a threat to the system. Well, every dollar that moves out of our US banking system makes the system more resilient. Banks are levered 10 to 12 times. Investors, 0 leverage. Mutual funds, 0 leverage. BDCs, 1.5 times leverage. Retirement services companies, 8 times leverage. Everything that moves out of the banking system deleverages.
So we've been talking about structural changes within the financial industry, actually, that have made private markets evolve. What about larger forces, what we're looking at right now? We've gone through a period of extraordinarily low interest rates, a lot of liquidity, as the United States and other places have pumped a lot of money into the system for good and sufficient reason. We had a pandemic, we had a great financial crisis. As that tightens up, as I assume it will, how does that change the equation for private?
It is absolutely the driving force. I mean, this is focusing on the urgent, which is what we were talking about before we came on air, versus the important. This is the important thing that's happening in our business. At our recent partners offsite, I put up a slide that said in 2008, Apollo, 40 billion of AUM. 2023, 650 billion of AUM. We grew 14 times. We outgrew Apple. We outgrew Amazon. We outgrew Microsoft. Pretty impressive stat. Next slide. Were we lucky or smart? We were lucky. You can't possibly plan on growing your business 14 times, but you can position the business in a way that you take advantage of powerful tailwinds or trends. What were the tailwinds? 2008, we had a financial crisis which pushed most financial institutions in the Western world on defense. People who had made promises to retirees, to pensioners, and had other obligations that were fixed, all of a sudden needed to look elsewhere for rate of return. They were willing to consider that perhaps private markets offer an alternative.
So Marc, let's turn to a different subject that you've been involved in. That's what's going on in the university and college campuses right now. You've been involved particularly at Pennsylvania and
Yes.
the Wharton School for a good long time on the board. Have things changed on college campuses, or has it always been thus and it's just been triggered by this Israel-Gaza phenomenon?
Look, I think we've actually seen a lot of change take place over time. So I have a very favorable memory of my experience at the University of Pennsylvania campus. But think more broadly. U.S. universities were and are the envy of the world. We can destroy that. We can lose it. Why are kids there? Why did we think they were there? Be exposed to different points of view, learn how to think, critical reasoning, critical thinking, maturation. Is that what they're getting today? I think in some places it is what they're getting, and in some classes it is what they're getting. But what I saw at the University of Pennsylvania and when I spoke out against was a dominant narrative that was taking hold on our campuses. Call it a post-colonial education, call it what you will. It gave rise to an institutionalization of a point of view that there were favored groups and disfavored groups, that there was acceptable speech and non-acceptable speech. I'm not sure that's the job that we all signed up for, or that's the university that we signed up for. What we're watching today on these campuses is nothing more than the outgrowth of 20 years of bad management. If you have a dominant narrative on campus, do you have academic freedom? Do you have freedom of speech? I have seen over the past few years, as I've really stepped up my involvement, professors, department chairs, who are afraid to speak their mind because their thoughts, their speech, goes against the dominant narrative. What we're watching today on campuses, we're told, are leftists. We used to think leftists were liberal. This hardly seems liberal. This actually seems illiberal in the most extreme way. Why haven't they been cleared out? Well, listen to Ben Sass at the University of Florida. We're all about free speech. We're all about the right to protest. But there's a time and a place and a way. You violate and trespass, there are consequences. Why would we not deal with them everywhere in that way? Certainly protests that were inconsistent with the narrative that we find on our campuses have and will be dealt with in that manner. Speakers are regularly shouted down. Professors, university administrators who did not react in that way without that kind of moral clarity, they now have encampments. Once you have encampments, You have the potential for violence. You have other considerations that come into play. But make no mistake, outside agitators, not mostly students, trespass, danger to the rest of the students and the rest of the community. This is what 20 years of a dominant narrative has done.
Having seen it from the inside, where is the failure?
The failure's in multiple places, but I think it starts with me and with us as trustees. We were asleep at the wheel for 20 years. Part of our job was to provide balance. I do not think the popular frame of a campus today where trustees and alumni are fighting professors over academic freedom is actually correct. I actually think the appropriate frame is university administrators who maintain this dominant narrative are fighting professors for academic freedom. Trustees and alumni are here to provide balance. We have been asleep at the wheel. We have not done what we were supposed to do. We did not object as these dominant narratives took hold, and it is our job, I believe, to support long-term excellence in education, academic research, freedom of expression, freedom to disagree. That's not what we have on many of our campuses today. We've gotten a long way from academic excellence.
How is that corrected without the trustees overstepping their boundaries? I mean, you know and I know, when you sit on a board, there are certain things you really need to do. You don't want to run the thing day to day. You don't have trustees there to be micromanagers. How do you have the proper role for the trustees without overstepping boundaries?
There's a question of overstepping. I think the danger right now is far from trustees overstepping the bounds. I think trustees, for the most part of these big institutions, myself included, have failed to act. We have not done our job in the most fundamental way. I don't think we are anywhere close to the line of overstepping our bounds. Most universities operate in a shared governance manner. Transparency is often the best disinfectant. I do not believe at the University of Pennsylvania or many of these campuses, the vast majority of professors actually believe in this dominant narrative. We as trustees can assure anonymous polling, representation across the faculty, lots of other things that we can do. Developing a strategic plan goes a long way, and as you said, it is not the job of the trustee or the alumni, for that matter, to run these universities. This is best left to professional administrators.
Marc, thank you so much. Really great to have you on Wall Street. There's Marc Rowan. He is CEO of Apollo Global Management.
Coming up, we turn from the politics on U.S. campuses to the geopolitics of industrial policy around the world with Karniol-Tambour of Bridgewater. That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is a special Milken edition of Wall Street Week coming from Beverly Hills. One of the subjects of this year's Milken Conference was how investors respond to an increasingly fractious world. We hosted a panel of major chief investment officers, including from Bridgewater and Temasek. And we start with Karniol-Tambour on how geopolitics may be driving the move toward industrial policy.
I think we've gone to a world where it almost seems desirable to people to see lack of convergence, to see divergence. You talk to businesses and, there's the ups and downs every day of what's happening with the U.S.-China relationship, but they get the direction. They understand that they need to get out of having that much reliance on China, and they're setting up for constantly talking about resilience. Now, what does resilience mean? It basically means you got to double do what you're doing and make it more expensive than it was before, because you weren't in China for no reason. You were in China because it was the cheapest place to be, because that's where you had cheap capital, because that's where you could set up most efficiently. So to go set up a double do, to go create resilience such that if there's a problem, you have a different way of getting your goods or creating them, that's expensive. So I think the biggest implication for investors is that we were kind of in this world where there was like almost a gravitational pull, like all else equal, of inflation to, 0, 1%. And that kind of underpinned a lot of the investment landscape, because it meant that central banks could always be easier than usual because they didn't really have any tension. If there's no inflation, you might as well just be as easy as you can at all times. What's the downside? There's no inflation. And this shift in geopolitics has been one of the really important drivers, kind of smacking us out of that world to a new era where the gravitational pull of inflation is higher, maybe to more like 2%, not a disastrous number, but one where that tension actually starts existing because you have all this structural spending that people feel they have to do, whatever the price. Some of that is just remilitarization. Without some of these geopolitical pressures, you wouldn't have that. But countries around the world are basically saying, I need to spend more on military activities. Some of it is corporates spending on redoing their supply chain. And the third type I'd mention is everything you're seeing in industrial policy. Officially, it's doing something else. For example, the IRA is going after climate. But I don't believe that spending would have been there without that backdrop of geopolitical competition and that sense that if China is willing to spend so much state money going after their strategic goals, why aren't we?
Karen, Bridgewater has been thought of in terms of China for some time. You have a long history there. And when you were talking about Asia, I don't think you mentioned India. So I'm curious about China with respect to India, and for that matter, other places like Vietnam and Indonesia, as foreign direct investment has seemed to fall in China. How do you assess India as an alternative to China, and for that matter, Indonesia, other Asian countries?
I think India is fascinating. It is still meaningfully smaller than China, as just kind of what the markets are like, and more difficult than China to transact in. So if you look at China, 7 years ago or something, it was very difficult for a global player to practically be in China. And so even if you weren't worried at all about geopolitics, about them confiscating your assets or anything, just logistically, the question of how do you buy a bond or how do you buy a stock was a challenging one to work through. And now a lot of that shifted and it's significantly easier, though it's obviously still harder to buy a Chinese asset. I shouldn't say obvious, they could have made it easier, but still easier to buy hard to buy a Chinese asset than say a European asset. But a lot of barriers have come down. So today, China is accessible. You can, as a global investor, build up a relatively meaningful allocation if you want to, and you'll get this extremely uncorrelated exposure that, in my view, even with pretty disastrous outcomes in China, may have reasonable return because the pricing is just so pessimistic.
Geopolitics went to court this week as TikTok sued the U.S. government over its forced sale. We talked at Milken with someone who wants to buy it, former Treasury Secretary Steven Mnuchin.
Mr. Secretary, give us your sense of the U.S. economy right now. How strong is it? Where do you see weaknesses?
Well, parts of the economy have continued to be quite strong, and obviously we're seeing inflation still being very sticky. So, the market has moved towards less rate cuts this year. I do think we're going to continue to see a slowdown of the U.S. economy at these levels of interest rates.
So you obviously worked for President Trump. President Biden's a different man, different economic policy. Is there anything you see in the Biden economic policy that you approve of, you think they've done a good job with?
Look, I think there's certain things that they've done that have been okay, but I think there's been a very different economic agenda. And prior to COVID, we saw the Trump tax cuts were really working. I think to the extent that we hadn't had COVID, we were seeing an increase in the economy and the cuts would have paid for themselves. And we were seeing very robust economic activity. Now, obviously in COVID, we had to spend a lot of money. I think had we not spent the first $2 trillion, we would have had a worldwide depression, not recession. But I think in hindsight, we went on to spend too much money. And I think when the Biden administration came in, they continued to spend too much money. And I think these deficits are going to come back and be a real problem.
We have a very strong U.S. dollar. Is that a good thing for the economy?
I think it is a good thing. I mean, for one, the dollar is the reserve currency of the world, and that's allowed us to finance these very large deficits. But over time, this is something we can't be reliant upon. I think the dollar will continue to be the reserve currency for the foreseeable future, but we have a responsibility to get our financial situation back in shape.
One of the issues that's pending right now are the Russian assets, central bank assets that have been seized in Europe and the United States. What should be done, if anything, with those? Do you have a view about whether we actually should be taking those assets and basically giving them to Ukraine for rebuilding Ukraine because of the war?
Well, first of all, I think the sanctions programs are very important, and it's a major foreign policy tool that the U.S. has. And I've always said, because we are the reserve currency, we need to be careful about how we use it. So the first part of this is making sure we put in place sanctions and we enforce them. I'm very concerned that the Russian oil sanctions and the Iran oil sanctions are not being enforced. We're seeing flagrant violations of those, and I think that has to be enforced. Now, in regards to what you do with the money needs to go through either a legal process or a legislative process, and I think there should be a healthy debate. But I think using the Russian money to rebuild Ukraine after the war is something should be seriously considered.
Since you left the government, one of the big moves you made was the New York Community Bank, buying it. Give us your sense of why that was a good move. There's a lot of concern about regional banks right now, although you know regional banks personally pretty well.
Well, I've been in the banking business for a long time. During the financial crisis, I bought 3 banks from the FDIC. We created the largest bank actually headquartered here in Southern California, One West. I've known New York Community Bank for the last 10 years. This was a merger of 3 institutions. And in them coming together, they didn't have the proper procedures for a $100 billion bank. They ran into some issues with real estate. So we raised over $1 billion of capital. A very large portion of that will be to build robust reserves. And we've come out with a 3-year plan to restore profitability to the bank. And by the end of 2026, the management team will deliver on a plan that gets the bank to an 11 to 12% return on tangible common equity and 11 to 12% CET1 to make it a well-capitalized bank.
One of the things you've expressed interest is in TikTok, or buying it from ByteDance. We now have legislation that within a year, as I understand, less than a year now, that unless they do something different, they're going to have to sell it. Are you still interested in TikTok?
Well, I'm still very interested in buying it, and to the extent they want to sell it or spin it off, we very much want to pursue that. I support that Congress passed the bill and it's now been signed into law. I will say this has had just incredible, overwhelming support with Republicans and Democrats. This may be the only thing that everybody agrees on. The fact that it's on 160 million phones, I do think it's a security issue in the U.S., and I'm glad that I see it's being addressed.
One of the big issues is the algorithm, right? This is very powerful for TikTok. Does the deal still work if the algorithm doesn't come with TikTok?
Well, the Chinese government has been very clear that they won't give an export license on the algorithm, and I understand that. We have sensitive technology that we don't want to transfer to them, and they don't want to transfer this to the U.S. I've actually spoken to a lot of tech companies on working about rebuilding this. I do believe the algorithms could be rebuilt. So my plan, if we were to purchase it, would be to rebuild the technology under U.S. leadership, make sure that it's all disconnected from ByteDance going forward, and that it is very robust and secure.
I understand. At one point you suggest you might talk to the former President Trump about this possibility. Do you have a sense of where he is on this deal?
I haven't spoken to him since the law has been passed on this. I've spoken to him on other issues. But, this started under his leadership. So I'm sure he understands the national security issues. And it was under his leadership that this really started.
You now are very active as a private investment banker. We have TikTok as a possibility. We have New York Community Bank done. What's the theory of the case? What's the connection? What sorts of deals are you looking at?
So we have 3 areas that we focus on, which are areas that we have a lot of expertise. The first is technology, with a big focus on national security and cyber. Along with myself, General Dunford, former chairman of the Joint Chiefs, is one of our partners. We also have the person who ran the cyber task force for the government. The second area is fintech and financials. Again, my general counsel was general counsel at Treasury and understands all the regulatory issues. I've obviously been around banking for 40 years. And the last area is entertainment and content, where, in my previous life, I made a lot of entertainment investments. And we're a big believer in what we call new content, and TikTok fits right in with that.
Well, you talk about a lot of turmoil. The entertainment industry, there's a lot of turmoil in media. We see it everywhere we look right now, including with Paramount most recently. But my old shop, Disney, has had some difficulties. There's a lot of challenges. Warner Brothers Discovery as well. What do you make of that? What is the future for the media entertainment business?
I think to the extent these companies can execute properly, there are very, very good opportunities, particularly given how low some of the values are on traditional media. I don't think the traditional media is going to go away overnight, but there's no question there's a complete transition in the market from the way when we grew up, from network TV to streaming, and not just streaming, to short form video and long form video that we see on TikTok, we see on Instagram, we see on YouTube. So there is a whole new distribution model. Having said that, great content has a lot of value. And a lot of these media companies have an enormous library of great content that can be mined. So I think distribution is a very important issue, that there needs to be a transition.
Coming up, we turn from a former Treasury Secretary to a former House Speaker and ask Paul Ryan about what's at stake for global Wall Street in this year's U.S. elections. That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. We are here in Los Angeles for the Milken Conference. And one of the subjects is the election coming up, and particularly what it means for the economy and for investors. So to get us through that, we have somebody who knows the economy very well as knowing something about elections. He's Paul Ryan, former Speaker of the House. He is also at Teneo and now is partner of Solomir Capital. So, Mr. Speaker, thank you so much for joining us.
It's good to be with you, David.
Most basic question for a lot of Bloomberg viewers is, we have the election coming up, presidential election, other election, the entire Congress. What is the biggest economic issue at stake? What could make a difference the most in the economy?
Number one would be tax policy. What's the tax code going to look like? What's tax policy looking like in the future? Number two, I'd say tariffs. So number three, I think it's reasonable to assume the next president is quite possibly going to face a debt crisis. You don't know when that is or exactly what form that takes place, but a lot of fiscal policies on the line, tax policy, trade policy, debt policy, therefore interest rates.
Third thing you mentioned was debt crisis, potential debt crisis for the next president, whoever the next president is. Take us through that. I mean, we've all been talking about the debt and the deficit, how much it's growing. Everybody says it's a problem. Nobody does anything about it. It hasn't really come home to roost yet, it doesn't seem.
What's a debt crisis look like? Bond auction failures. I mean, it's not inconceivable that once the Fed's done cutting rates and people aren't buying bonds as readily, and you've got U.S. and all these other industrialized countries with the same problems, aging baby boomers, entitlement programs unfunded, papering this, floating all this paper in the world markets, you could have an oversupply of bonds, and it's not inconceivable in my mind in a handful of years, next presidency, an auction or two fail, and then the Fed steps in and buys our paper, and then they're really monetizing debt. That's bad for the dollar. That's bad for dollar dominance. That's an interest rate problem.
You know this terribly well. Can we get our fiscal house in order without increasing taxes? I'm not saying we shouldn't cut some spending too, but can you do just one and not the other?
Yes, you can, for sure. I can show you how to do it. I passed 4 budgets in Congress that did it. But in politics, that's a political question. My guess is if you have divided government, there's going to be a mixture of both. I believe you can have a better, faster growing tax code that still gets you higher revenue lines than what we have today without doing damage to economic growth. Now, the way I would do it would be a cash flow tax reform. That's not the way Joe Biden would do it. The question is, can you get more revenue for the federal government to get our debt under control, coupled with entitlement reforms, and do it in a way that doesn't sacrifice economic growth? I think the answer is yes to that. But nobody's talking like that these days. I guess the question is, what could you do now, knowing we have debt problems in the future? I think there's a couple of things Congress could do. They're not, but maybe they'll get something done. I think stablecoin legislation would be a good step in the right direction. That could be helpful. That could be done this year. But I don't see anything other than that on the horizon.
Okay, Mr. Speaker, thank you so much for joining us here. That's Paul Ryan of Teneo and Solomir Capital.
Real estate has been something of a punching bag for investors, and one of the topics for discussion this week has been whether we've seen the worst of it. Barry Sternlicht of Starwood Capital was outspoken at the Milken Conference, and we asked him about where he is looking for pockets of opportunity.
The good blocks, data centers are good blocks today. Anything with power. It's true. I think it's just interesting to see, the real estate is not, you can't use one word to describe real estate. You can play up and down the capital stack. You can make mortgages, mezzanine mortgages, preferred equity investments. You can buy homes. You can buy students housing. You can buy senior housing. You can buy land. You can buy single family for rent, build to rent. You can buy industrial. I mean, there's so many different flavors, and it's hard. The one thing that is true about the real estate markets today is because of Powell's rate movement, we have a sort of a balance sheet crisis. We don't have an asset level crisis. For the most part, the asset classes, at least in the United States, are fairly in balance, supply and demand. There's a little bit of oversupply of multifamily in some of the growth markets, but that will get absorbed over the next 18 months, and we'll be back to a very healthy rent profile, I think. But for the most part, people are going to have trouble refinancing their debt because interest rates rose 500 basis points. And also many of the traditional lenders, like the banks, are backing out because they're full up to their gills in real estate loans.
Markets react to things like interest rates, like work from home. They also often overreact. Have there been overreactions on the downside for office, for example, some places, or on the upside for data centers? Because we hear so much about data centers. Is there a danger of getting overbuilt?
There's a regulator on data centers because the project is so expensive that if you don't have a lease, you can't finance the construction. So it's almost impossible to overbuild it. There will be people who will buy land in the hope of getting power, in the hope of getting a tenant, and they may wind up losing a bunch of money if they paid too much for land, and it has no alternative use other than their dream of someday getting a power source. So I think it was Stanley Druckenmiller was at this conference, and he said, like, it might be overhyped short term, but it's underhyped long term. And I think that's probably true. What we try to think, I try to spend time thinking about is AI's implications on the real estate markets. How are things going to change? And then what it's going to do to destabilize or support some of our tenants, right? So which ones will go the way of the dodo bird? What industries will be heavily impacted? And will they come up with new applications that require them to keep as many people just doing different things? Or will they just have people do everything? I was listening to Jensen Huang speak at a conference the other day, and he showed how they can build a boat through AI, a very complicated super tanker. And then he said, we can build the factory that builds the boat, and then we'll build the robots that build the boat in the factory. And I'm like, where are the workers? What do we do? I was thinking, well, I'm going to continue to invest heavily in resorts because everyone will have all this time off and they'll be working from our hotels in Hawaii. I think AI, is just the beginning. I know how it's going to change so much. And it's very exciting and also terrifying.
Is there a day of reckoning coming in real estate?
The great thing about our system is capital will adjust and find the opportunities. I do think it's going to be a rolling wall of thunder. Every time a loan matures, it's a negotiation or an explosion. There's an extension. A borrower tries to come up with money. He doesn't have it. He has to go to people like us, or in the old days, there were doctors and lawyers and friends, and raise the money to pay down the debt rather than give the asset back. It'll be market by market, asset by asset.
You mentioned return to office. It wasn't that long ago. It wasn't return to office in New York. It was just leaving New York altogether and moving to Miami.
Yeah.
Have we seen peak Miami for the time being? Because there was a time that everyone was rushing down there with their employees and things like that. And now you hear maybe not so fast, they're coming back a little bit.
Miami has an issue because of schools. It doesn't have enough schools. And that's probably the reason Miami's slowing. But Amazon just announced they're moving taking 50,000 feet. There are a lot of companies that would move down if they could get their employees' kids into schools, which is impossible. So you got to be very bullish. Citadel, which obviously left Chicago, I mean, they alone have decided they're going to make Miami into the financial capital of the United States, and they have the power to do that. Ken is very philanthropic, and he's moved a lot of 1,500 people into the market, and that affects the housing market. We're waiting. I mean, if I was really smart, I'd just buy all the houses in Coral Gables and sell them to the Citadel employees as they move down. I don't think Miami's peaked. I think Miami and Florida have sort of cycles because they get overbuilt, but they're ever higher cycles. You just have to have stamina and stay with it. The housing market, a $4 million house became a $10 million house, and now it's an $8 million house, but it's still twice what the guy paid for it 4 years ago. And really good stuff. I mean, recently Barry Diller moved down, Jeff Bezos has moved down. I anticipated the climate, that obviously the weather's better. I anticipated, certainly in the winter. I anticipated the tax savings, and obviously for the darkest blue states, it's material. I didn't anticipate how welcoming the state is to business and how success is actually applauded, not vilified. So I think for businesses, that's a nice thing. The state wants you to succeed, and they want to attract business. And maybe the blue states, the governor of Florida said, I guess he got on a phone call with the governor of New York and said, stop taking my people. He says, every time you talk, I get another tenant. So.
Barry, you made some news this week about Brown. You've been a loyal supporter of Brown. Have done an awful lot of good for that school. You said for the time being, as I understand it, you're going to really suspend further donations. Why were you so upset about what they did? As I understand what they did is they agreed with the students they would talk about divestment. They just talk about it. What's so wrong about talking?
I think schools and the country needs to get back to facts. Get to the truth. 1 and 1 is 2. It's not 4. Even if the students tell you it's 4, it's 2. And I think the number one place you should teach the truth is universities and schools of higher education. If in fact these universities don't approve BDS, they don't divest from Israel, the kids will say people like me influence the board. They need to know the facts first. I am about the facts. And if you know the facts and then you're pro-Palestinian or pro-Hamas, I'm not I believe in a two-state solution. But I don't believe in the right to return because there'll be no Israel.
So given what we know, what should Brown have done? Or for that matter, not just Brown, Columbia, my alma mater of University of Michigan. This is a problem across a lot of colleges. What should the adults do?
Encourage free speech and debate, not violence, not hate speech. No child should have a fear for his safety walking around a university campus. Get rid of the agitators. It should occur to somebody that the attack on Israel on October 7th was right. The rumor was the Saudi-Israeli peace conflict was going to be solved. This well-orchestrated campus demonstration happened after Iran shot 300 missiles into Israel. And Israel responded with sort of a light touch, like, we can get you, but we're here. And then they pulled back, right? Because the administration said, don't do anything. And they kind of did, but nothing, right? The world sentiment was shifting against Israel. Unleash the Kraken. Let the kids protest all across the United States campuses. It was well orchestrated by these SJP and all these organizations that are being funded by some left-wing organizations. If I were the president of Brown, I would say, we stand with the democracies and free speech. Israel's not an apartheid state. Here's the proof. Israel's not committing genocide. Here's the proof. If you don't like it, I understand. That's great. Leave your keys on my desk and go to another university. My father survived Germany, so I have a lot to say. I'm just not going to be quiet about it.
It's clear you feel strongly about it. A lot of people feel strongly about it. But when you make a decision like, I'm not going to contribute for the time being, is that an expression of your views, your principles, the feelings you're talking about, or is it an attempt to change behavior? Do you think it'll go beyond an expression to actually change behavior?
Look, I don't think these universities, Christina Paxson's a great president at Brown University. She's trying really hard. She's got these universities have very left-leaning faculties. You should not have a tenured professor who said there was no Holocaust. How can you teach that at Columbia University? How could that person have a job? And if you thought that was fair, if you had a professor who said there was no slavery, it didn't happen, would you have him as a tenured professor? Or if a professor who's saying he celebrates and thinks that at Cornell who thought the Hamas should be celebrated, killing innocent children and parents? They should be shown the door. And I don't want to pay for them, so I don't want to support a university that houses that language.
That was Barry Sternlicht of Starwood Capital. That does it for this special episode of Wall Street Week, coming from the Milken Conference in Beverly Hills. I'm David Westin. This is Bloomberg. See you next week from back in New York.